You can go ahead.
Okay, so I appreciate everybody joining us today. I know it's a rough day to try to fit something like this in for all of us, but it's a pleasure to be here. This is an excellent event. It's awesome, so I'm happy to be here. Let's dive in. Today we're talking about trading with catastrophic insurance instead of stop loss orders. As I'll say over and over and over again today, most traders, when they think of risk management, they think of stop losses. And I get that because nobody wants to be caught in a 100-point S&P move on the wrong side. That's what stops are for. But the problem with stops is in more normal market conditions, particularly, you tend to get stopped out at the worst price, the high of the day or the low of the day, and then the market goes the way you thought it was going to go, but without you. So we're going to talk about ways to get around that using options or smaller contracts or just a different approach to the market. So anyway, let's talk about that. So if you're not familiar with who I am and what I do, my name is Carley Garner. I am a futures and options broker. I live in Las Vegas because the weather's much better here than it is in Chicago. Most of our industry stays in Chicago. If you have any questions about anything that we talk about today, or you want to learn more, you can find us on social media. We have a YouTube channel that has, I want to say about 40 or 50 educational videos. We have them also on our website, CarleyTrading.com. We're on Facebook, Twitter, Instagram. For full disclosure, I do post a lot of pictures of my dog on Instagram and Facebook. So if you're not into dogs, you might want to stay away. But this is Frankie. This is what we do basically all summer, all day, every day, splashing by the pool. So I write a monthly column for Stocks and Commodities magazine. I also write content for Jim Cramer's Mad Money. About once a month, he uses our analysis on his show. Generally talking about oil or gold, sometimes treasuries, sometimes the stock market. And I mentioned before, we are a brokerage service. We do offer newsletters and trading recommendations to our brokerage clients through the Financial Futures Report and the Carley Perspective. You can sign up for trials on our website, or you can download our mobile app and sign up for a trial there. Even if you never trade with us, the mobile app has a ton of good information, news feeds, video feeds, all kinds of valuable information. It also does contain our trading recommendations if you're a client or if you're on a trial. So just one more shameless plug. I've written multiple books. The two that I would recommend at this point are Higher Probability Commodity Trading and A Trader's First Book on Commodities. The first one basically tells you everything that you need to know in regards to analyzing a market, putting a strategy together, and even placing trades. Trader's First Book on Commodity is everything you need to know before you actually place a trade. And people tend to overlook that. They think they can just trade with any random broker, whoever has the cheapest commission rate or whatever their criteria is, but that is absolutely wrong. There are a lot of things that you have to do to make sure you're trading with a broker that fits your needs, because every trader has different needs, whether it's day trading or option selling or whatever it is. I've yet to see a broker that is really, really good at everything. There's usually one thing they're good at, so you have to make sure you're in the right spot. Also, you have to make sure you understand the basic math involved in trading. I know that sounds really silly, but most people jump in and then later ask, well, how much am I going to make or lose? And that's not the right way to do it. So that book will teach you everything you need to know before you actually trade. And I'm actually in the process of writing a book. It's supposed to be done by now. It's not. I mean, I was planning on having my rough draft done by now. I should say that. We're hoping by probably midsummer. I'd say midsummer, we're going to have it out on shelves. It'll be titled Trading Commodity Options with a Purpose, so be on the lookout for that. So now let's get into the reason we're here. There is a substantial risk of loss in trading futures and options. It is not suitable for everybody, especially on a day like today or a week like this week. In fact, I would say it's probably not suitable for most people. For the average person, it's just not. I don't know. I assume that there's some of you in this room that trade futures. I bet a lot of you probably trade stocks. The great thing about futures trading and options trading is the leverage. The bad thing about futures and options trading is the leverage. So we're going to show you some ways to kind of manage that and hopefully mitigate some of the risk here today. The reality is the futures markets aren't any more risky than the stock market or the Forex market or any other market you want to talk about. The difference is the futures markets are leveraged, and most people don't understand how to manage that leverage. And they also don't understand that leverage is their own choice. You don't have to use the leverage. For example, if you're trading crude oil, the margin is, I'm going to round just to give you an idea. So the crude oil margin, we'll just say it's 5,000 right now, but you're making or losing money based on $50,000 worth of crude oil. So you can see there's leverage there. You're only putting 5,000 down, but you're making or losing based on a $50,000 contract size. You don't have to use that much leverage. In fact, you probably shouldn't, because if you're using all of the leverage the exchange gives you, you're giving yourself very little room for error, and you're probably going to lose money, blow out your account, or worse. However, if you fund your account with 50,000 and you buy one crude oil futures, you've eliminated all the leverage. So as you can see, you control the leverage, not the exchange. So it's not that the futures markets are necessarily more risky, it's just people trade them with full leverage and don't understand that they control their own leverage. Anyways, so let's go back to talking about stop orders. Don't be afraid to be different. Stop loss orders aren't always what they seem. Nearly every book or course ever written suggests that you should always have a stop order. You can't get on Twitter or Facebook without going into the trading communities and seeing memes about people that didn't use a stop and now they're dead or whatever they are. So there's memes. Everybody just assumes you should always use stops. But what I'm going to propose to you today is maybe what's comfortable and common isn't always the most efficient. Maybe stop loss orders do more harm than good. It's Murphy's Law. Traders are frequently stopped out at market highs and market lows, causing the maximum pain, and I'm talking financial pain and emotional pain. And what happens next? The market goes in the intended direction. I wish it wasn't true, but it just is. Markets are sadistic. It happens more than you would think would be probable, but it just does. And these premature stop outs trigger counterproductive emotions. And those counterproductive emotions lead to poor decision making. So there are advantages to stop orders. Obviously, they're a risk management tool. They reduce the risk of a runaway trade. They, you feel like you can't, especially in a market condition like we're seeing this week and last week, you can't even get up to get a cup of coffee without coming back to a bloody trading screen. Sorry, guys, I'll be right back. I apologize, technical issue. Okay, I apologize for that, and I did fib a little. It actually was a technical issue. I'm a broker. The futures markets never close, so sometimes there's emergencies. Anyway, especially on a day like today, there's fires all over the place. Where were we? Okay, so the great thing about stops is you can get up and get coffee without coming back to a bloody screen. There's comfort in knowing the absolute risk. With that said, stops aren't absolute. There's slippage. The markets can gap through your stops if you're trading things like pork belly. Well, I take it back. Pork bellies aren't even listed anymore, but lean hogs or cattle are prone to gaps. Most of the financial commodities really don't gap much anymore because they trade about 24 hours a day, but over the weekends they can. Anyway, stops are also nice because they mitigate emotional duress. caused by the decision on when to pull a trade that's gone bad. It's really hard. I know we're human. Nobody wants to admit that we're wrong. Nobody wants to take a loss. Even, I mean, I see it all the time. Traders, even a $10 or $30 loss, people are willing to hang on to a trade that they really don't even have faith in, just because they don't want to pull the plug and take a loss. And unfortunately, it's our human nature that does us in. So the great thing about stops is it takes that sort of poor emotional decision making away. But the worst part about stops is there's really no way to get back in once you're stopped out. There's no chance at recovering the losses once you're stopped out. I mean, I get it. I fully understand that when you're stopped out, you can immediately get back in and chase the market higher or lower, or whatever it is. But that generally does not end very well. I think we can all attest to that. So sure, you could get back in, but it also really kind of defeats the purpose of your stop. If you were just stopped out and you immediately get back in, which again is human nature, you might as well not have had a stop in the first place. All you did was pay your broker, pay a little slippage, and cause yourself some emotional turmoil. So everybody has a different opinion on stops. I'm sure there's people watching this right now or listening right now that think I'm a complete idiot. So that's okay. But this is just what I've witnessed. And I've been doing this since 2004. I've been doing it a long time. I've seen every trading strategy or system known to man, the good, the bad, the ugly. My assessment is trading without stops can be devastating if you're in the wrong place at the wrong time, but trading with stops generally means taking small to moderate losses over and over and over and over and over and over again and watching your account bleed. So there are alternatives. One thing is you can trade the micro and mini products. So I'm talking about futures here. There are micro stock index futures, which are just completely fabulous. They came out last year just in the nick of time, right before a lot of the summer volatility hit. And then during these market conditions, a micro is a great way to get your foot in the door without risking the farm. There are micro metals, which are also fabulous. And by the way, the stock indices are generally like the E-mini S&P. They're 1/10 the size of an E-mini. So the micro is 1/10 the size of a mini. So on the E-mini, well, I should say on the S&P micro, it's $5 a point rather than $50 a point. So you can see it's much more manageable. So people can scale in and scale out, and you may not even really have to worry about stops, even on a day like today, where the S&P is up or down 120 points. That's only a $600 move. So you're probably not going to ruin your life. You're probably not going to get rich either, but it's a way that you can scale in and out of positions without having unfathomable, like unmanageable risk. Micro gold is the same way. It's 1/10 the size of a contract. So for every dollar gold moves up or down, you're only making or losing $10, not $100. So you can see these types of contracts, you don't necessarily have to use stops. You might have a really bad day, but you're not going to have to sell your house or anything crazy like that. You're just going to have kind of a crappy day. You made or lost a little bit of money, no big deal. Another way to get around the use of stops and the difficulties of stop orders is to buy options to protect your futures position. So what I mean by that is if you go long a futures contract, you can buy a put option to protect it. If you go short a futures contract, you can buy a call option to protect it. Obviously, insurance is not free. We know this in our daily lives. But what it does do is it limits your risk absolutely. There can't be slippage on options. If you have an option in place, it doesn't matter if the market gaps up, down, or what it does, your risk is absolutely limited, no slippage issues at all. You do have to pay a premium to buy that option, so you have to be careful. You don't want to spend too much money on it. And you can decide how aggressive or conservative you want to be based on where you place your stop, and we're going to show you a couple examples of that. Or the third alternative is if you want to go even a little less aggressively, Rather than trading futures at all, you can just trade options. The exchange has done a really good job at listing weekly options. Basically, these are options that instead of expiring every month, they expire every week. And in fact, in the S&P and even some of the currencies and a few other things, they expire every Monday, Wednesday, Friday. So if you are let's say you're a swing trader or even a day trader. Let's say you're putting on a trade in the morning that you think you'll be out of either by the evening or maybe the next day. So you only need insurance for 24 hours. You can buy an option that probably expires tomorrow or the next day. And the benefit of that is it's going to be very cheap insurance. Instead of having to buy an option that expires in 30 days for a fortune, you can buy one that expires in a couple days for a little amount of money, and it gives you the ability to sleep well at night. You know what your risk is, and you know the worst case scenario. Let's talk about using long options for stops, or long options instead of stops. So options provide lasting power. That is the point. A trader that's sidelined prematurely due to being stopped out has no chance to recover. Those that are using options instead of stop loss orders always have a foot in the door. Things can always get better. Even if the trade went wildly against them and they're sitting in a position that looks like it's going to achieve the maximum loss, it can't get at that point, it can't get much worse. It can only get better. Somebody that's trading with stops cannot say that. If it gets to their maximum loss point, they get stopped out, they're out of the market, and they're on the sidelines watching everybody else either make or lose money. So another thing to just point out, we all know this because we've probably all experienced it, unfortunately. When you're trading without stops, let's say that you acknowledge that stop loss orders can work against you, but you don't want to spend the money to buy insurance using options, so you just trade naked without stops. The problem with that is, if you are in the wrong place at the wrong time, it's a very emotional experience, and you're probably going to puke out your long positions on the low or be squeezed out of your short positions on the high. That's just how our brains are wired. We can't see things logically when losses are piling up. That's how it tends to work out. So I'm not recommending, when I say don't trade with stops, I'm not necessarily recommending trading without stops unless you're trading the really, really small products like the micros. I'm just saying maybe there's a different way to protect yourself than stop orders. So this is an example of the sell-off in December 2018. Now that, actually, I'm going to refresh after I get done with this class today, or maybe sometime later this week. We now have a really good sell-off to use on a slide like this, so I'll just update it for the most recent sell-off. But since 2018, the December collapse, we really hadn't had any good sell-offs to use as an example, but now we do. So I'll have to update this. But this is really just an example to show you how being stopped out at the low or puking your position out at the low, how painful it can be and how big of a burden it can be on your trading account. I mean, you could literally ruin years of trading on a decision that you make in a couple of days. So imagine being stopped out on Christmas Eve, 2018, near the low of the day. Within 2 days, the S&P had recovered $10,000 per contract. That's like roughly 200 points per contract. And then in the days following that, it was a $25,000 move. So just imagine being stopped out on the low or just throwing in the towel at the worst spot and then watching the market run right back up to where it was before all the turmoil happened, but this time without you. It's really hard to recover from that, both financially and mentally. So let's take a look at it. This is just kind of a hypothetical example to give you an idea of, let's assume that you're bearish in the S&P. The market, this is around 2,900. You have a couple of choices. You could buy a put option. We're not going to talk about that today. but you could go short a futures contract and place your stop order around 3,000. Let's say you want to give it roughly that much room, which is a really deep stop, by the way. I'm not saying you should do that. This is just a hypothetical example. But if you go short from 2,900 and place a 3,000 stop, you're giving the market 100 points in leeway. That's quite a bit of room, and unfortunately, it would be a big loss if you got stopped out. So this trader would be risking $5,000 on one E-mini S&P contract, and let's say his profit target or his expectation is for the market to retest the 2725 area, which is the recent low in this example. So in essence, he's risking 100 points to make 175 points. $5,000 risk for possibly $87.50 in profits. I don't know about you, but that's a little deep for me. I personally probably couldn't stomach that type of a risk reward, but everybody's different. The thing about trading is you should pick a strategy and you should pick a trade, even an individual trade with a risk reward that fits your personality. If you're trying to trade above your means or beyond what your comfort level is, you're going to lose money. Even if the idea is right, even if you're selling the S&P a few days before a crash, you're probably going to mess it up because mentally you're not there. Really, it's really important that you make sure you're doing something you're comfortable with. You can live with the risk, all of those sorts of things. Otherwise, you're just asking for trouble. So the alternative to selling the future and placing a stop at 3,000 might be to purchase a July 3,000 call for 7 points. So we're still limiting our risk above 3,000, but this time instead of placing a stop, we're buying an option for 7 points. That 7 points adds to our risk because we can't just ignore the fact that we had to pay for our insurance, just like when you buy your car insurance. If you have a fender bender and they write you a check, it's not like you come out ahead. You've already paid your insurance premiums and they're just giving you part of it back. It's the same thing in the commodity market. So this trader would have a risk of 107 points or 53.50 and a reward of 8,400. His reward is lowered by 7 points because he spent 7 points to buy that insurance or that protection. This too would be too deep of a risk for my tolerance, but again, everybody's different. What I would probably do is what we're going to talk about on the next slide is to use an option with shorter time frame and a lower strike price. That way your risk is lower. That said, the benefit of doing it this way as opposed to just placing a 3,000 stop is it doesn't matter if the S&P goes to 3050, 3100, or 3400, as long as it comes back down into your profit zone, which is roughly 2900. As long as it comes back down to 2,900 before expiration, you still are in the trade and you can still have the potential to make money. I mean, we've seen it over and over, right? Markets have blow-off tops. They have huge, huge rallies and then suddenly they collapse. I mean, not unlike what we've just seen in the last month or so in the S&P. So somebody that had put a strategy like this on might have actually survived. They may have went short of futures, bought a call, and their timing might have been completely horribly wrong. And a few weeks later, suddenly the market's crashing and they're in the money. Somebody that placed a stop would not have had that luxury. They would just be out and then they'd have to watch the market crash without them. Somebody that went with this strategy would still be in the game. And that's really the whole point. Okay, so let's look at a slightly modified example. Same idea. Let's not place a stop order because we don't want to get stopped out at the worst case scenario. But if we buy a July 2950 call instead of a 3,000 call, our risk is cut to 3,500. So we trimmed almost a couple of $1,000s off of our risk. Our profit potential goes down a little bit, but not much. And again, the point of this is You control your risk and reward, but you will always have lasting power if you're using options instead of stop orders. Now, in these two examples, we're using options that expire down the road with various strike prices. We could just as easily buy a 29.50 call that expires next week for very little money. If we think that we're only going to be in the trade for a week or so, there's no reason to buy insurance for a month. So you don't have to spend very much money if you're only planning on being in the trade a few days or a week. You might even be able to. Now, in today's market condition, it's not really possible. The options are really expensive because the volatility is high, and it makes things a little more difficult. But in a normal S&P, well, I shouldn't say normal, but based on like 2019 volatility levels, which were actually kind of on the low side, obviously, you could put on a trade with a risk of far less than $1,000, probably closer to $500, that lasts 2 or 3 days with limited risk doing this sort of thing. Oops, I'm sorry, I think I went backwards. So just to kind of reiterate what we've talked about, the 3 largest obstacles to successful day trading or swing trading are premature stop outs, emotion, and let's face it, day traders, if we're specifically talking about day traders often scramble to get out of their positions before the close to avoid full margin. But if you're trading with options or hedging with options, you should get span minimum margin, which is exchange minimum margin. It's a portfolio margining system. Now, with that said, it depends on the broker you're using. If you're using a discount broker, forget about it. You're not going to get that discount. But if you're with a legitimate futures and options broker, they will give you span margin. If you sell a futures contract and you buy a call, the margin is mitigated, and you won't be forced to hold the full overnight margin. So you can hold into the close without any issues. You don't have to scramble with the rest of the herd trying to get flat before the close. So the practice of buying options eliminates all 3 of these obstacles to successful day and swing trading. So we mentioned briefly that you could consider trading micros without stops. The micros are small enough that you probably just simply don't need a stop loss order. So it's really very, very simple. Trade smaller. If you are trading small enough, you're going to be emotionally comfortable, financially comfortable, and you would be able to simply ride out any adverse move, hopefully. So a product that I really, really have grown to love is the Micro E-mini Stock Index Futures contract. They were created by the CME to overcome the largest obstacle keeping retail traders from trading futures, and that's risk. Because the contract size is so much smaller than the E-mini S&P or even the big S&P, most of you probably have never heard of the big S&P. You're probably wondering what I'm talking about. Believe it or not, there is a big S&P that trades only in the open outcry pit, and it's kind of a dying product. It probably won't be around a whole lot longer, but it's worth 250 points per point. I'm sorry, $250 per point. So if the S&P goes to 3,000, from 3,000 to 3,001, you made or lost $250. So it's like basically having 5 E-minis, but in one contract. Anyway, that's just a fun fact for the day. The micro contract is 1/10 the size of a mini, so you have the same leverage, but less risk in dollar terms. Percentage terms, your risk is the same. I mean, nothing changes, but you're just trading such a smaller contract. To give you an idea, it's basically, depending on where the S&P is valued. If it's at 3,000, the micro is trading $15,000 worth of stocks, and if you're trading the mini, you're trading $150,000, just to kind of put it in perspective. So what this does is it gives you more room for error. You don't have to be perfect. You probably don't have to trade with stops. You can add to losers. I know everyone says don't do that, but we do that in our retirement accounts, right? It's called dollar cost averaging. So in trading, if you're trading small enough, you certainly can add to losers, assuming everything is all everything all lines up. Your trading strategy all still lines up. I'm not saying add to losers that simply don't, your signal's gone. There's no reason to hang on to it but hope, and you're a prayer, not a player. I'm not saying that. But if everything still's in line, like we look at seasonals, we look at COT charts, we look at market sentiment data, all of these sorts of things. If everything still tells us the same thing and we're in a trade that's gone bad, we might consider adding to it. If you're trading small enough with the micros, you could do absolutely that. There are 4 major stock index futures, and these all have micros: S&P 500, NASDAQ 100, the Dow Jones, and the Russell 2000. So you can trade micros on any of these. They're futures only. There's no options, but they can be used to hedge option risk on similar ETFs or E-mini futures options. So for example, if you're selling puts in the E-mini S&P, and the market starts to sell off, you think you want to get delta neutral, you could sell 1 or 2 micros against it. Now, if the S&P crashes like it did this week, your micros aren't going to keep up with your option because the option's based on an E-mini, which is a little bigger contract. But I mean, it just gives you some idea of some things you could do. Also, if you're not interested in trading and you just want to hedge your portfolio, these are awesome. Let's say that you have a portfolio of $100,000 and you're roughly, we'll just make it easy. Let's say a quarter of it's in S&P 500 type stocks, a quarter of it's in NASDAQ 100 type stocks, a quarter of it's in Dow, a quarter of it's in small caps. In theory, you could sell 1 or 2 micros against your stock portfolio and basically eliminate most of the price risk while you're still getting dividends. I wouldn't do that now with the market cheaper, on the cheaper side, but when it was really expensive, 3,300, 3,400 in the S&P, absolutely, that would have been a great place to put some hedges on. That way you still get your dividends, and you don't create a taxable event, but you still have some price hedging going on. So I'm not going to go into this in too much more depth, but just to kind of give you an idea of the point value of each of these contracts, the S&P micro is $5 a point, $16,000 notional value if the S&P is at 3,200. That means you're controlling or you're making or losing money based on $16,000 worth of stock. The margin on that's only about roughly 700. It's actually 750, 760. So let's say under 800. So for under $800, you're making or losing based on $16,000 worth of stock. So you can see it's pretty efficient and it is leveraged. It's just small. The NASDAQ is $2 a point. The Dow Jones micro is 50 cents a point, and the Russell micro is $5 a point. Don't let the Russell fool you. It is a micro and it is only $5 a point, but it can move. When it decides to move, the Russell can be really volatile, and that's because it's made up of small cap stocks. So the purpose of this chart is really very simple. All I'm trying to do is show you the difference between trading a mini S&P future and a micro S&P future. I posted this on Twitter and somebody yelled at me and asked what I was trying to prove and am I telling him to go short or long? And I'm not doing any of that. All I'm trying to say is if you're caught on the wrong side of the E-mini S&P, let's say your timing was just completely horrible and you refused to take your loss and you write it all the way down from October 2018 to December of 2018, there is a good chance you'd be losing $31,000. If you did the same thing with a micro, you'd be losing $3,100. Not ideal, and hopefully you wouldn't hang on and write the whole thing down. I'm not saying that you should or maybe anyone would do that, but just give you an example of the difference in how much money we're talking. And you can see if you're losing $3,100 from the absolute high to the absolute low in I think that was a roughly 20% correction, and you're only out 3,000, you can see there's so much more room for error in a micro than there is the mini. Of course, you're not going to make as much when you're right, but you're not going to lose as much when you're wrong, and that's really the point. So another thing that we could do if we don't want to use stop orders is not trade futures at all, just trade options. Now it's not perfect when you buy options. I can't teach you everything about option trading in one class, but when you do buy options, your risk is limited and you have lasting power no matter what happens until option expiration. You're still in the trade and it can always get better. Okay, so the great thing about options is lasting power, limited risk, no slippage, you're always in the trade, all those sorts of things. The bad thing is you're paying for time value. So if you buy a call or a put and the market goes the opposite direction, the premium will go down pretty quickly. You will lose money pretty quickly. That's just how options are priced. And options are priced to lose. So there's no free lunches here. I'm not trying to insinuate that. But if you think you have some sort of edge in predicting price moves over the, intraday, whether it's day trading or whether it's over the next couple of days, if you've got an edge in predicting price changes, you can do it with options in a much more comfortable scale than you would with futures. Again, you're not going to make as much, but you're also not going to lose as much, and you don't have to worry about premature stop outs. So prior to weekly options, we really only had monthly options to work with, meaning if we were speculating on the S&P today, we could trade March options, which expire in a couple of weeks, or we could trade April options, which expire in about 6 weeks, so on and so forth. So you weren't able to really pinpoint what you wanted to speculate on, and you often had to spend a lot more money than you wanted to because you're paying for time you don't need. But we don't have to do that anymore. Time is money, so options with substantial time to expiration are expensive. Now that we have options that expire every Friday, and like I mentioned before, every Monday, Wednesday, Friday in the E-mini S&P, we can pinpoint our speculation. We don't have to spend a lot of money. It's not uncommon to see an option that's trading for $100 today be worth $300, $400, $500, $600, $700 tomorrow. Now, again, that doesn't mean that you're guaranteed to make money or that it's easy. I'm just letting you know that options can move that much. And it's a lot more comfortable than trading the futures outright. I'm going to show you a couple examples of an option change just to kind of give you an idea. So I like to think of day trading or swing trading with weekly options as a poor man's day trading because it has limited risk, it has lower risk, and you don't have to worry about margin. Again, the margin on an E-mini S&P is over 7,000. So if you hold a E-mini S&P into the close, you have to have at least 7,000 in your account per contract. If you're trading options, if you're buying calls or buying puts, all you have to have in your account is what you spend on the option. So if you're buying an option for $400, it doesn't matter if your account has a balance of $600 or $300 or $500. As long as you have the $400 to buy the option, it doesn't matter. You don't have to worry about margin. So you can trade with a lot of leverage in a smaller account. I'm not saying you should. I'm just kind of giving you the concepts here. So don't misinterpret that. Because the delta of an option is lower than a futures contract, the delta of an option is basically how quickly it moves relative to the underlying futures move. So that your option is going to make or lose value slower than your futures would. So it's a slower paced game. It's not as exciting probably, but again, your odds of success are probably greater because you have time, you have more room for error, and you have lasting power, and it makes a really big difference. Anybody that's trying to trade in these market conditions knows how valuable lasting power can be. ironically, I feel like a lot of futures traders, day traders or swing traders, when they get into trouble, they tend to run out of money at the worst time. They get a margin call, or they simply just, not even a margin call, they just run out of money in their account. When you're trading futures, technically you can lose more than you have on deposit. So they tend to run out of money exactly where the market turns around. And I don't know why it happens like that, it just does. So options prevent all of those sort of horrific events from happening. So some of you might be asking, do weekly options move enough? And absolutely, they absolutely do. A couple things to keep in mind. An at-the-money option has a delta of 50, meaning if the futures market goes up 10 points, the option makes or loses 5 points. I'm sorry. So on an E-mini S&P, a 10-point move in the future is $500, but a 10-point move in the option, an at-the-money option, is probably going to be about $250. Now, it's not exact science because option values are based on time, volatility, and demand, and these things cannot be predicted, so it's not black and white. And some people hate that about options. They want black and white answers. You're not going to find that in options, but that doesn't mean you shouldn't consider trading them. So this is actually an option chain snapshot that I took, I believe, last week. And oil was moving a little bit, and on this particular day, oil was down about $2.35. So you can see the price of oil is at 51. It's dropped $2.35 today. So the purpose of this is really just to give you an idea of how the options might move. All right, here we go. Okay, so let's look at the 53. These are the 53 puts on this side and calls on this side, and you can see the high and low of the day. The high of the day was $1.20. That's $1,200. Sorry, I shouldn't be. I think I'm making it harder to see. But the high of the day was $1.20, and the low of the day was 23 cents. I'm not suggesting everybody's going to be capable of buying the low on the option and selling the high, but I want to make sure you understand there's a roughly $1,000 worth of profit potential there. So if you were lucky enough and savvy enough to have bought that call option on the low of the day, you might have been able to sell it for a $1,000 profit, or vice versa. On the put side of things, and actually, that probably wasn't the best example because this was a down day. More than likely, it started the day around $1,200 and then ended the day around 200. But let's look at the puts just to get a better feel for it. So the 50 puts would have been out of the money coming into the day. They settled at 22 cents the previous day. So for $220, a trader speculating on the next day's action could have gotten into the market and maybe made 60 cents. So that's about a $600 move on that option. The 50.5 put maybe did a little better. You might have seen a $750. I mean, assuming you bought the low and sold the high, and that's a huge assumption, but I'm just trying to show you there is some profit potential there. It's not unheard of for an option in crude oil that expires, and these expire in 4 days. It's not unheard of for a $200 option to jump in value to $600-700. Happens all the time. You have to time it right. You have to be in it to win it, and that's not as easy as it. Talking about it's a lot easier than doing it, but it is possible. Those opportunities are there. Another thing I want to point out also is with this type of trading, you control your risk. So if you're buying an option for $200, a 20-cent option in crude oil, that's the most you can ever lose. You're choosing to only risk $200 on that trade, no matter what happens. The world could come to an end and you're only going to lose $200 on that trade. If you're willing to risk more, if you want to have more skin in the game and you want to be more aggressive in hopes of more profit potential, you could risk $500. You could buy an option for 50 cents. You just work your way up and down the chain to see how much you're willing to risk and what your expectations are. So this is just again to point out how lasting power makes a big difference. Had a trader bought a crude oil week 4 $50 put with 7 days to expiration for 20 cents on the spike last week, he might have had an opportunity to sell it for $1.24 a few days later. And actually, if it was possible to fast forward the slide a few more days, I'm sure crude got down into 43, 44 area. So that same option would have been probably worth $7,000, $8,000, maybe more. So that was a $200 risk. And if you had the wherewithal and the gumption to just hang on to it, I'm not saying I probably wouldn't have been able to foresee that big of a move. In fact, we definitely did not foresee that big of a move in crude oil. But there is some profit potential there. So even a $200 risk with lasting power, no risk of getting stopped out, can put you in the right spot. So in conclusion, just wanted to point out that we do offer quite a few educational videos and articles on our website. So I know we tried to cover a lot of information today, and it was probably a little fast. If you need more time to digest it, there's a plethora of information on our website. Also, we'd love to hear from you. If you have any questions, feel free to email me or call me. And if you're a reader, my books are available at any outlet, but they are cheapest on Amazon. So if you go to Amazon, you'll find both of them on Kindle version as well as hard copy. And they tend to discount them pretty nicely with free shipping, so it's hard to beat that. Here's all my contact information. Check out our YouTube page. If there's anything that we can do for you, just let us know.
Thank you so much, Carly. If you guys have any questions, Carly's still here. She still has the mic.
I'm still here.
Yeah.
Also, if you think of questions later on, feel free to email them to me. That's fine as well. Or call me, whichever.
I was just going to suggest that because oftentimes, oh, Dawn, you asked a question.
Let's see. So Don's asking if we cover the SPX. We do not. We only deal in futures and options on futures. I mean, honestly, you'll find brokerages out there that will offer both products or both arenas. To be 100% frank, nobody is any good at offering both. If you're going to trade futures, I really recommend you get a futures broker and then a stock broker for your stock trading. It's almost like if you go to a Chinese restaurant and order a hamburger, it's on the menu, but it's not what they do. So make sure you're trading with the brokerage that does that. We do not offer SPX, but I'm sure you could do a very similar type of strategy in the SPX. I've just never personally tried it. Okay, that must be it. So if you think of anything else, please send me an email. We'll make sure you get it taken care of.
All right. Thank you so much, Carly, for accepting the invitation. And we plan on doing this event again next year. So
yeah, let's
if you're interested, yeah.
Sure. Yeah, thank you.
A lot of